it's different, but similarly, if you had a euro receivable and a USD entity, I would argue you need to book an unrealized gain loss until settled, and then a realized gain loss at settlement. If you have Bitcoin, I think the functional treatment is the same.
All right, Michael. Of course, this is a great icebreaker. So how did you first get interested in crypto? What led to starting your career in crypto and Web3? Love to hear your story there.
Yeah, sure. So, yeah, so before I start, hey everyone, I'm Michael Cieri, and I'm currently the accounting manager over at Polygon Labs. Ari, you did say my last name pretty well, so good job on your introduction. Thank you. But yeah, Richard, to your point, so I first got interested in crypto. It was recently after getting out of the CPA program and kind of starting my career in accounting and end of 2015, early 2016. And I was working at EY at the time as an auditor. And I stumbled upon this gentleman named Peter Saddington. He's I don't know if anybody I don't know if he's still active. He was he was or still is kind of a Bitcoin maximalist. He was always preaching, you know, it's never too high of a price to buy Bitcoin. And I watched a ton of his videos and got kind of down the rabbit hole of like, what is crypto and like, what does it mean for the world? What does it mean for me? And I really just resonated with the ethos behind it. And I got very interested in trading along with that and was trying to figure out a way I could like be a part of this industry with the skill set I have. I tried to develop this like a technical trading strategy and go down that path. Didn't work out. And I was like, okay, like I'm really, you know, I have this professional background in accounting and I work at EY and I've built some really good experiences. And I was like, how can I kind of marry this interest I have in cryptocurrency, this like kind of newfound interest with what I know how to do really well professionally. And I kind of was like, okay, let's try to work. Like, how do I do that? Let's break into a centralized exchange. Like, let me go work for a centralized exchange. And at that time, it was during the 2017 bull run. You know, there was a lot of interest growing in crypto, but I think the accounting departments were very, very thin. So there wasn't a lot of opportunity. So it took a couple of years for me to break in, and I was kind of working in real estate and oil and gas and these other industries, but messaging people trying to kind of break into a crypto accounting role. And about 3.5, 4 years ago, I got involved at Kraken. I got hired at Kraken. And that's where it all kind of started for me, from kind of marrying this interest, this huge personal interest in the space with what I kind of did professionally. And yeah, started at Kraken, got totally involved in accounting for crypto, how to, from technical accounting considerations with all the kind of, I'm sure we all know kind of the nuances that surround that, along with how to operationalize crypto accounting within your main ERP, which was at the time NetSuite. So learned a ton there and recently pivoted to Polygon, where I kind of took on a massive role of standing up their entire accounting department really from scratch, which is where I've been for about the last year. And yeah, where I'm currently at, and trying to build upon the accounting department, as well as, you know, learn a couple of things along the way. So.
Awesome. It's great to see that kind of passion in Web3. So you specifically sought after jumping into this industry using your professional.
Yeah, definitely. I think like maybe a lot of CPAs out there, I wasn't like super, I did all the right things, went to a big four, but had no idea what I wanted to like do with my career. Like didn't have a plan. And when I found crypto, I was like, I can really put these two together and develop, you know, like build off of that for my career. And that's worked out well for me so far. And it's something I, you know, it's nice to feel strongly about the industry that you work in, and which is something like I really can't say I cared about oil and gas like previously. So it's a nice, it made me develop a sense of like, I'm involved in my own way in building this Web3 kind of blockchain native like environment that we all hope takes, main adoption in the, coming years.
Amazing. Yeah, that's a great story. Thank you for sharing that, Mike.
Yeah.
Perfect. So the second subject here, we'll jump into right away subledgers. So before we get into the specifics, let us just ask the question: what is the concept of a subledger?
Yeah.
What does it come across you in your mind?
Yeah. So it's actually like a good question. And I think at the highest level, away from crypto, away from everything, it's really a location to aggregate and record data away from your main accounting ledger. And I would even argue within ERPs themselves, there are subledgers. Maybe it's a department, a location, a class, a different cost centers, a project you might be recording costs to. So there's really, to me, that's what a subledger is. It's just a location away from your main ledger where data is recorded and aggregated. Maybe you want to go look at the operations department subledger of the GL account comp expense, right? And you can kind of navigate there. And I use NetSuite. I've used NetSuite for many years in many different companies. So you'll probably find that I reference NetSuite a lot. But you can easily navigate to that subledger view to get that more granular level detail that might not be like readily visible or apparent on your main GL. And then I think in the context of crypto, right? They've really, these software like Cryptoworth has really expanded upon this idea of subledgers. And now you're taking this whole subset of transactions that originate on chain and really aggregating it, making it much more digestible, and memorializing that data there and pushing it to your main ledger. So to me, like the idea of the crypto subledger is it's a real, like you're capturing, it's a huge breadth of transactions that the criteria is just, it's on chain. That could be anything, so it's this really overpowering, over-encompassing subledger that is super helpful. If anybody has been working in crypto for maybe even a month in accounting capacity, the struggles that exist in ERPs, and they really haven't kept up with the industry. So things you can do on Cryptoworth, for example, there is absolutely no way you could do natively on even NetSuite, which I would think is the most malleable at this time. So I think that's what a subledger is to me. Do you really need it in the context of crypto? I think, like, excluding very fringe cases, yes, you're not tracking cost basis on an Excel spreadsheet. You're not tracking it would be foolish to track your FIFO inventory on manually. It's not operational if you have a multitude of wallets to go query the block explorers and like copy and paste details. Sure, you can do it, right? But it's doable, but it's not sustainable or operational. So any crypto operation, or even if you're not a protocol or Web3 entity by chance, but if you even have some level of transacting in crypto, I would say you need a subledger to bridge the gap between what current ERPs can deliver and what is really needed from a crypto accounting in a crypto accounting environment.
Thank you for sharing that, Michael. And so a lot of people have different opinions on what a subledger is supposed to do, because so many people have different use cases. But yeah, what are the obvious main purposes of the subledger and what it's supposed to achieve, at least in an overall high level point of view?
Yeah, to me, it's to aggregate data related to a subset of the population. So it's like, whether that's a you know, in a more general sense, whether that's a project, right? You might record all your costs to a project subledger. So you could, that's not present on the GL, right? That's not, you're not looking at the GL and seeing XYZ project. These are the comp attributable. This is the CapEx, like whatever it would be. You're not seeing that. But on a subledger, you can record to a direct project and view that in isolation. So to me, that's like what a subledger is. And in crypto, it's a more broader, it's crypto transactions being aggregated on in a environment away from your main ledger, and being able to be, you know, and then you can, that's the high level goal. It's like crypto transactions. And then there's obviously a crypto subledger can also have additional capabilities like that. Like that's the bread and butter to me. But then categorizing, coding, put how they get to your main ledger, how they're married in with your fiat transactions and stuff and are presented on that main ledger is like the secondary step. But at the heart of it, it's just a location to aggregate data related to some subset of a given population, whether it's a project, whether it's the type of like whether it's fiat versus crypto, like whatever it is. That's what it kind of means to me.
Okay, and the subledger setup is quite a unique concept because it's really for the Web3 industry. You don't really see that in other industries. So given that you're working with two ledgers, essentially one fiat focused, one crypto focused, and of course, the subledger merges that crypto data into the fiat ledger in a way that's processed. Because you're working with two different ledgers, what do you think in your experience, or I mean, in your experience, or what do you think maybe in the industry where that time split is between the main ledger and the subledger? Is it equal split? Is it mostly in the main ledger? Is it mostly in the subledger?
Like, are you talking about where you kind of spend the most time or view the data? Yeah, so
yeah,
I think it's dependent, right? Like, I think it's all dependent on how you're, number one, the scope of the entity and the amount of transactions, right, on chain compared to on a fiat rail. But I think like for Polygon, I would say 50% of my time is dealing in crypto and more of a subledger view, where I'm trying, you know, and that's because pulling data manually off block explorers just isn't efficient. Getting cost basis like manually, like whether you're disposals on certain assets and realizing the gain or loss and really figuring out what your cost basis was on that asset that was disposed. Like you could do that in a Google sheet, right? But like it's not practical. So I would say a lot of my time is spent and I'm operating in kind of a unique environment, but being that, you know, I work for a protocol and we have deal with a very limited selection of assets outside of our native token. So, you know, maybe there are other entities that would have more complexity to their crypto accounting, but nonetheless, even with the few assets that I deal with, there's still a large volume and I'm constantly dealing in like a subledger type environment.
Sure, that makes sense. So in conclusion, it depends. If you have a lot of transaction volume, more likely you're going to spend more time in the subledger. And
a huge thing too, and I think we'll touch on this later, is creating a workflow that like you can't have like your fiat world and your crypto world need to come together at like very few entities like are 100% on chain, right? You know what I mean? Like there needs to be that relationship and there needs to be a sense like they can't be conflicting and contrasting. They need to come together in a certain way that makes sense at, you know, for month-end close, for reporting. Like maybe you need to query like your total comp expense and write a footnote based on how much was fiat, how much was crypto, what currencies, like whatever. Like there's an end, like outside of externally reported financial statements and having an accurate like balance sheet and income statement and cash flow statement, like there's so much there's so much need to really dig down into these and be able to pull reports and have this data really presented together. So like subledgers are great. Like I love Cryptoworth, but I think getting that data into a, you know, if it's not all crypto, it needs to be aggregated, and it needs to be aggregated like meaningfully. It can't really live in to me, it's challenging if you have like your comp expense is like totally bifurcated between crypto and fiat, and you need to go to two different locations to kind of source that level of detail, you know what I mean, to be able to tie out to the total comp expense for that like period.
Yeah, that makes sense. You want to reconcile, and you need both ledgers to do that.
Yeah, and it's even a part, you know, one step past reconciling, it's like using that data for strategic, and like, you know, it's not all just about recording it, right? You need to be able to utilize and view and dig in to that data for like strategic initiatives, as well as accounting initiatives. For, you know, a big thing to me, like at Kraken, was like footnote disclosures, and like having that data to be able to be queried together is super, super important.
Right, of course, that makes sense. So we can jump into the next slide here and move on to the next subject. So the asset presentation levels, this is a really big one. A lot of companies have different setups, and a lot of accountants coming into Web3, this is a big question for them. They're always wondering what is the best setup, because it also depends on their transaction activity, their complexity, if there's any edge cases as well.
Mm-hmm.
So I know you can talk about probably how you would set up on-chain assets on the balance sheet in your experience, but I'm just curious what you think the industry as a whole, what you would recommend, generally speaking, how to reflect on-chain assets on a typical balance sheet.
Yeah, so, and I'll talk about this not in the sense from a technical accounting standpoint, like whether it should be an intangible asset or mark to market, or with respect to the new accounting guidance. I'm strictly going to talk about the way the assets should be viewed from like a grouping perspective. So like if they should be, you know, if you should reconcile wallet to wallet, if you should reconcile like to like an asset level, like all my Matic is in for entity A is in one account, or is it bifurcated between which wallet that Matic is in real life? So there is no like good answer, I think, for this question. Unfortunately, I think it's very independent to the entity and the situation that you're in. That being said, I think what works the best for me, and what I like try to work towards, if it's operational and a sustainable practice, is reflecting the wallets on my balance sheet. So like, let's just take to make that, people might be confused like what that means. Like, I'm not exactly sure, but what to illustrate that, let's just say you have two simplistic structure, two entities, each have two wallets, one OPEX wallet each on the ETH chain, maybe it's a Gnosis safe, and then one investment wallet that you use for certain investing or maybe DeFi related activities as well, right? I would put let's say on entity A, you have OPEX wallet 1, DeFi wallet 1. I would have a balance sheet account for OPEX wallet 1 and a balance sheet account for DeFi wallet 1. And I would record the transactions and in the number of tokens in NetSuite. And I would reconcile each individual wallet, the outflows, in the number of tokens. So I wouldn't be pushing anything in USD. I wouldn't be pushing anything. I would push them in the number of tokens. So let's take OPEX wallet 1 on entity A. Let's say that has USDT, USDC, DAI, and Matic in it, right? Let's just say that. And we had one outflow that month in a super calm, simple month of $1 million USDT, right? I would, ignoring the payable and the settlement, like I'm ignoring AP, right? I'm going straight to expense and straight to the credit to the wallet. I would debit in my GL the expense for $1 million at a header level of USDT, and I would credit that OPEX wallet 1. And then at the end of the month, I would, assuming that's the only transaction, I would pull my OPEX wallet 1 foreign currency view on in NetSuite. I would see $1 million currency symbol USDT outflow, and I could go to Cryptoworth or whatever, the block explorer even, and see $1 million USDT outflow. My ending balance and in the number of USDT would tie to my ending balance in the number of in NetSuite. So it's a super easy way, if you can swing it to number one, like to really confirm completeness, just like you would reconciling a fiat bank account. And you can configure NetSuite in such a way that you can record all these different currencies underneath one wallet, pull that foreign currency view, and see exactly, like pivot it out or do whatever you want, and see exactly what outflows or inflows happened in which currency, and match it exactly to what you see on chain. And that's like, I think, in a simple to maybe like intermediate environment, what I would recommend, and that's what I do. And if you ever need to do impairment or you have other accounting considerations outside the wallet, I would handle that in a separate account, like totally separate from that. What I'm trying to say is that wouldn't impact the inflow and outflow of number of tokens to confirm completeness and reconcile. So to answer your question, like that's what I would recommend, but that's not practical in like maybe everybody listening to this call. Maybe you have 100 wallets. Maybe you have maybe you have the wallet hygiene in the company you work for, where they're just like spinning up wallets. Like you can't be like, you don't want a balance sheet full of wallets. And that becomes a mess, and it also becomes operationally like not sustainable. So I'm not opposed to, in certain environments, grouping wallets, like in creating like a DeFi grouping and reconciling to, like, you have 10 wallets in the background, you pull all the assets together, all that activity, and you record to this DeFi wallet grouping, if that makes sense. Or at the highest level, doing it by asset. So like by entity, by asset. So USDT, like stable coins, Matic, and one line. If you do that, that might be operationally easier and more efficient, but you lose so much granularity on your GL. And I like what I like to see at Polygon, and in combination with our treasury and stuff, is like it's proven to be very helpful to show like, this is the amount of I'm making this up, this is fictitious, but like this is the amount of stablecoin, X stablecoin, and Matic or Aave, whatever we have, and this is the amount we have actually in that wallet from a treasury perspective in real life, and that is a one-for-one comparison. So that's proven to be helpful, and I think I'm lucky enough to be in a situation where it's feasible. But that won't be able to be. I think everybody needs to take a unique look at the environment, the wallet hygiene, how many wallets they have, and the operational processes, to make sure that's something that can actually be achieved before they like try to like copy that, for example.
Yeah, so the level of granularity, you're obviously advocating for the most granular approach, wallet level presentation, pushing, syncing the nominal amounts as opposed to the fiat amounts. So it's most likely going to be the most audit friendly approach, because the amounts that you see per transaction, the movements that you see by transaction will be reflecting identically to what you see on a blockchain explorer, right? You can even verify on a blockchain explorer, not even through the subledger, right? So that's a nice benefit. And if you have auditors, they could just go straight to the main ledger and then blockchain explorer. What would you recommend as a setup for a smaller finance teams or one-person finance team, smaller startups? We do see a lot of Web3 startups with just like one-person or two-person finance teams. Would you recommend these companies to pursue that level of granularity as well, or would you say to start off with, for example, asset level presentation in the main ledger?
I mean, I think again, like, I think it's totally dependent on the number of wallets. Like, we have a pretty, like, shout out to Desmond. I see he joined the call. He's another accountant over at the Polygon team. And he is a excellent accountant that actually designed a methodology to do this really seamlessly. So I think if it's set up in a way where, you know, it all depends on like what's needed and what the use case is. If you have a really small team and you're okay with that, and you're okay with that level of that totally rolled up view, and you feel like you can get supportable, like you can support completeness, go through an audit and have a really built out work papers in the back end, or you're really confident in your subledger like Cryptoworth, like, then I think it's okay. I don't think it's a bad thing. I think what gave me comfort is that ability to tie out and like very simply confirm completeness over the reconciliations in month end, and make sure all my expenses, for example, or all my movements are recorded. That's what's important. Can you get there without doing it like this? Absolutely. And maybe that one person team strategically gets there a different way. That's just, I think, for me, you know, what I did at Kraken and what I do at Polygon, and I worked in both cases. So yeah.
Awesome. And just to quickly go over the pros and cons. The pros of the wallet level presentation: more granularity, more audit friendly, and then maybe pros for the other method. What would you put in that category? Would you say quicker setup, maybe a little bit more speed?
Yeah, I'd say quicker setup, a little bit more speed, which you sacrifice that level of granularity on your GL. Might be totally fine and might totally work for the environment that you're operating in. I don't have anything against that. Like I you know, sometimes I wish we, you know, like sometimes, like, because what this does entail is like we do record movements in between wallets. So like, whereas that's a non-reconciling entry in a asset level presentation, right? You have Matic, you don't care what wallet's in. Like, you have USDC, you don't care where it is. But on our GL we do, and Desmond will tell you, like, we book those journal entries.
Fantastic. Yeah, that's really good insight, Ted. Michael, thank you for sharing that. Let's move on to the next slide here. So main ledger syncing strategy. This is a very interesting subject. So what is the most effective syncing strategy to the main ledger? You touched upon this already in the previous slide. So fiat value or nominal push. We know that you're pushing nominally the amounts, the crypto amounts into the main ledger. Do you want to maybe just share your opinion on why? Oh, okay, you talked about the granularity aspect. Would you like to share any other maybe benefits or advantages of using that method over, for example, the fiat value? And if it matters, what stage of the company, like does the stage of the company matter? Would you encourage actually smaller companies to take on that strategy from the beginning, because maybe it's hard to switch later?
Yeah, that's a good question. So for me, outside of the areas we just touched on, you know, having that level of detail for me is important. Going back to like that Kraken, like constantly needing to put together like footnotes and stuff based on the number of tokens, not the spot rate at the US at the transaction amount, like at that time, but number of tokens that we were related to each expense account and department and things like that. So that level of granularity from a reporting perspective is helpful. But even more than that, I think like, and I think maybe we'll get to this later too, is saving what you're doing outside of like completeness checks and having one-for-one comparisons on chain is you're saving in NetSuite, at least. Like you can't do this. I think it's very challenging in like QuickBooks, and I'm not sure about Xero, but like in NetSuite, you're saving a foreign currency value, right, in your ledger, which can be used for a multitude of things. So if you have an embedded derivative in your receivable that's bifurcated out, right, like you that needs to get revalued, and unrealized gain loss until it's settled will have a realized gain loss. You can just run, if you, here, I'll give it a quick example so it's clear. Let's say, or let's just say you're following the new guidance, right? With like with respect to Bitcoin, and you have one Bitcoin, right? And you that you have a receivable in Bitcoin for whatever reason. Maybe you have revenue generated in Bitcoin, whatever. And you book a receivable, and let's say Bitcoin pumps up to 100K, and your receivables established at one Bitcoin at a rate of 100,000. Well, the functional currency of your entity is, let's say it's in USD, and just like it's different, but similarly, you would if you had a euro receivable in a USD entity, I would argue you need to book an unrealized gain loss until settled, and then a realized gain loss at settlement. If you have Bitcoin, I think the functional treatment is the same. So you would, if you booked your receivable at one Bitcoin at a rate of 100,000, you in NetSuite could run with the click of a button unrealized, and let's say that receivable existed over month end. You could run your unrealized gain loss, would take the month end rate and the currency tables built out in NetSuite, and revalue that Bitcoin, that receivable, and book an unrealized gain loss against that receivable. So let's say it's a gain, you would credit gain, debit to increase the value of that receivable. Now that receivable is worth more money in theory than it was at the beginning of the month when it was established. Then when you settle that receivable in NetSuite, NetSuite can automatically book that realized gain loss and permanently true up debit, or if it, let's say it's a gain again, debit the receivable and credit gain. That's something that you would struggle to do if you booked that receivable at the like spot rate, or what like at a USD equivalent and converted. Then all of a sudden, of course you could track it in an Excel spreadsheet or Google Sheets, but you're losing that granular, you're sacrificing that like ease of use that can be utilized in NetSuite. All of a sudden you have 15, 20, 30, 40, 50 receivables, and you're like tracking that's going to be a huge task. So, and it's a similar thing with payables too. If you save the payable, if you create a payable, you're also going to have an unrealized gain loss for the time that liability, between when that liability is created and month over month until it's settled. And then you'll have a realized gain loss at settlement. All of that can be done super, super easily. We don't even think about it in NetSuite. It's just done because it's at the click of a button, natively in the system. So that's like outside of like completeness testing, like simplicity of reconciling. That's why I think it's also cool to save it as a foreign currency in NetSuite. Like, so to summarize that, I know I talked a lot, like you have your, like the ease of reconciliation and easy one-for-one tie-outs with no ambiguity and going back and forth between a converted amount at some rate and the nominal amount on chain. Then you have the ability to query any of that data via safe searches and different reports in NetSuite for footnotes, for operational, any operational initiatives or strategic initiatives, or for FP&A to gain insights into certain things. And then you also have that functional, from an accounting standpoint, saving that currency as a foreign currency and utilizing that to your advantage by way of unrealized and realized gain losses on whether it be an embedded derivative or whether it be say it's Bitcoin with the new guidance that the FASB's recently come out with, that where it looks like Bitcoin will be a fair market value asset going forward, and possibly some other crypto. But yeah, that's my perspective. Again, though, like there might be situations you might be dealing with an ERP where that's not possible and doesn't make sense. That doesn't mean a USD push is like wrong. I think you're just maybe you don't need that level of reporting, and maybe you're not going through audit, and it's like you can live with that, like maybe deviation from GAAP or whatever the IFRS or stat reporting requirement you're up against. So no, it's not a hard and fast rule. I think it's just something to consider instead of just kind of, I think a lot of people push in fiat. I think it's something to consider if you haven't already thought about it.
And the nominal push, it sounds like you would probably just recommend it if the company is using NetSuite, because it might be overly difficult on the other.
So yeah, so I know it's challenging in QuickBooks. I've never done it in a system outside of NetSuite, because NetSuite, like I know you can, and there you very well might be able to, and another, I don't think you can in QuickBooks, but there might be another ERP where you can do it, but you can build currency tables in NetSuite for Matic for anything with a currency pair. Like you can save those currencies, and either manually or through suite apps like Cryptoworth, you can push in those journals. So like we create a bill, in Matic, we create a bill at the header level of Matic with the number of Matic, and then it has a rate and it's converted at that rate on the face of our financial statements. Just say it's an expense, right? Like let's say it's a comp expense in Matic, hypothetically. That would get, let's say it was a million Matic at 50 cents. So it has a USD, the base currency, the entity it's being booked in is in USD. It'll have a financial statement impact of $500,000, but that 1 million Matic will be saved as a foreign currency. And that will allow you to utilize all that FX reval that I mentioned earlier.
All right. Yeah, I think that is that's very interesting to hear. So yeah, let's move on to the next subject. I think it's we have the last one here. ARAP. So here we want to talk about what are the crypto ARAP challenges you're seeing, and I would say, to add to that, how do you deal with embedded derivatives in crypto accounts receivable and accounts payable?
Yeah, so I think I touched on that. I probably overspoke on my last question and touched on that. But again, like we book Matic, USD, whether even if it's a stable coin, we track the amount of stable coin and the stable coin, the unique stable coin, whether it's Circle or Tether or whatever, we track that in NetSuite. We'll book a bill in NetSuite at that currency level. So if we needed a derivative revalued, for example, super easy, right? If we need a realized gain loss booked on the settlement of AP, super easy. We utilize the system. The other thing, and maybe the question isn't speaking to this, but I just thought about it, is people, like one challenge I had is trying to think about and this is again away from embedded derivatives, away from the technical accounting component of all this, but the operational component of like how and where you create your AP bills, for example. And I think that is a challenge that a lot of people might use like Airbase or other things, but they can't handle like a cryptocurrency, generally speaking. So another thing to consider is your AP flow. Again, I'm deviating from the question, but like how your AP flow, how are you going to create bills denominated in crypto? Where are they going to be created? How are they going to route through an approval workflow, for example? And how are they going to get reflected on your main ledger? And there's a different strategies and by way of doing that as well. So AR and AP can be definitely challenging from a technical accounting perspective to get the correct accounting reflected, as well as from an operational accounting perspective, to the point of like, you generally don't want, or I wouldn't want, like fiat handled here, crypto bills handled here. So finding a solution that can, deal just as well with crypto and fiat, I think is important. And that is something that like really challenged me at Polygon. Like when I first started, like, how do you create a non-conflicting environment between just a bill, just a bill denominated in crypto and a bill denominated in fiat, and you don't want two separate workflows for, at the end of the day, an AP bill. And if you're paying a lot of stuff in crypto, which a lot of Web3 companies probably are, that's a real challenge you have to kind of contend with.
Right. So another major benefit of the nominal push is that it makes it super easy to reconcile these crypto invoices and bills, because you're able to move from the unrealized gain loss entry to and trigger that realized gain loss.
Well, that too, yeah. Like on the accounting financial statement impact side, it's like if I book a bill in ETH, right, and I have a payable in ETH, that the change in rate at when that payable is created and established, right, like that gain or loss and true up to AP, right, it'll be a debit to AP, credit gain, or debit to, if it's a loss, it'll be a debit or loss, credit to AP to increase the AP balance. But that happens, like, we don't even think about it. Just happens, like when we book and apply a payment.
That's amazing. We see so many companies really struggle with being able to for example, mark as paid these crypto invoices and bills. Sometimes they're created on the main ledger, and it's a challenge to mark them as paid.
Yeah, no, that is a challenge. Marking them as paid is a challenge, because like it can be, because you're like, what we did is we created our own weird little way to mark bills as paid. Again, shout out to Desmond. And there is an operational component that we're trying to fix, and you guys know as well as I do, Cryptoworth is like a huge driver in that. So we can do better, and we will do better, and we'll make it more like, I think we've laid good groundwork. I think we have the basis for a good thing, but now it's time to build upon that and automate and create. It's sustainable, but to create it really, like, be more efficient and free up resources to focus on more strategic initiatives, rather than manually applying JEs to bills, for example, to apply them as paid. So definitely, I mean, it's still a struggle for us, but I think we're on the right track.
Awesome, that's great to hear. I think we're closing up here. Thank you so much, Michael, for taking the time with us for this Q&A. I'd love to have been able to hear about your story, how you got into the industry, how you solved such a technical financial challenge in this industry, in where you're at, and also sharing basically your strategies with everyone else here. There's a lot of accountants coming into Web3, who are learning all these strategies. They're brand new to many people. So I just want to say thank you so much for joining us today.
Yeah, no, thank you guys for having me. I really appreciate it and enjoyed the conversation.